There's always market volatility. There's always an excuse to sell. But if you step back and take a long-term view to investing, even a really long-term view, you'll probably make smarter decisions. That's just one insight shared by this week's MoneyShow MoneyMasters Podcast guest. During our November Virtual Expo Fireside Chat, which we're releasing here as a special episode, we also covered the outperformance of foreign markets relative to the US and what to do about it, how to capitalize on concepts like shareholder yield in your portfolio, and the explosion in yield-enhanced ETFs. Plus, we discussed the quick recent transition from crypto summer to crypto winter and whether it's something that digital asset investors should worry about. My guest is Meb Faber, Chief Investment Officer at Cambria Investment Management. Meb, welcome. It's kind of interesting. I gave you a little bit of an introduction, but I was wondering if you could share a few things with the audience here, talk about your background a little bit, especially because you actually studied engineering, science, and biology back in college. So how you're here in the financial arena, how'd you make that transition?
We're taking it way back to university times. As I like to tell people, the years start peeling off. And I say, when I graduated in 2000, that was 10 years ago. Wait a minute, hold on. No, that was 25 years ago. But during the last real great bubble in the US, that was a fun time, honestly. My professors were trading stocks during class. Anyway, yeah, I'd started out, I was a biomedical engineering student and worked, my first stop was a biotech stock fund. And if you know anything about the early 2000s, that was just as bad as the internet stock. So that didn't, that would, all, everything we did went down like 80, 90% too. Did a little stint as a ski bum up in Lake Tahoe and then found myself here in Los Angeles down in Manhattan Beach. So it's a beautiful sunrise over the Pacific this morning, and started this company. It's going to be 20 years ago next year, so I can't believe it. But we're 2 decades in, and we've grown up over that time. We now manage money for over 150,000 investors around the world. We are soon to have our 20th fund launch next month. Mostly ETFs is where we are this day and age, and we put out a lot of content. By the way, the name of the Cambria funds. We put out a lot of content, which used to mean academic papers and books, and the more modern age means, blogs and Twitter and YouTube and podcast, and who knows what's next. Webinars with y'all, and yeah, it's been a lot of fun.
Yeah, great. I appreciate it. We're glad you could have you here on the platform to talk about this market, which is, I guess, where I'm going to start with. I mean, as we're meeting here, it's funny. You were saying before we launched this about how there's always volatility, there's always craziness in the market to talk about. But certainly in the last week, last month, we've seen crypto have issues. We've seen a lot of these AI stocks, some of the air come out of that sector. So I'm curious. When you look at this market overall, where do you think things stand? What do you think about some of the activity we're seeing at this time?
We gave a speech recently this past year, and it was called Four Things. One, something to be worried about with a solution. And then two, something that nobody's talking about, which is actually in the fixed income space, and your listeners may find it interesting regarding the topic of today. And then lastly was something that no one's heard about. And so the something to be worried about is, I feel like, well discussed. I feel like everyone knows it. It's just like a game of musical chairs where everyone's just waiting for the party to end. It's like the old punch bowl, everybody's waiting for the closing time song to go home. And that's just the U.S. equity market. And the U.S. equity market has been on just a face ripper the last 15 years. If you look back, it's one of the 4 times in history where U.S. stocks have done 15% a year for over a decade. Amazing, absolutely astonishing period. Everyone pat themselves on the back when you're at Thanksgiving, say, I'm grateful for the stock market, see what your friends and family say. New Year's, cheers with a little champagne and say, it's been a good run. I went on TV the other day and I said, look, you're talking to your clients, talking to your friends, say, this is as good as it gets. Now, no one wants to say that in the moment, but it feels true. Only 3 other times in history have U.S. stocks done this. It's been in the Roaring '20s, amazing, 100 years ago. Nifty 50 period. Most listeners probably weren't around for that. And then, of course, my favorite, the internet bubble. And on the backside of those, times weren't as good. Great Depression, inflationary '70s, bubble burst, and GFC in 2000. It doesn't mean those bad times have to happen, but in general, markets go through these regimes And it's more than anything, hey, maybe we shouldn't expect 15% returns. And usually the good times lead to something which is high valuations. And right now, this is the thing that everyone discusses and knows. Stocks are expensive, second most expensive they've ever been, other than the 2000 peak, which usually portends lower returns going forward, but not always, right? Things can get crazier. If we know anything about markets, where we love to study history, and Japan was certainly crazier in the 1980s than we are today, and the 90s were still crazier than now, but it's definitely feeling a little funky.
So much of this, whether it's from economic growth and spending on data centers, whether it's the sort of borrowing and spending activity that's fueling or greasing the wheels on Wall Street in the AI space, that's really been a big force here for markets. And now you're starting to see, people raise questions. Are companies like Oracle borrowing too much? You see what's happening in the CDS market there. Is it something to pay attention to? Talk a little bit about the credit and the borrowing and spending environment and what your thoughts are on that.
There's always a number of levers. It's always challenging. We're writing a new book called Time Billionaires that hopefully will be out next year. And it's a history of stock markets back to 1600. And so it's fun to look back in history because it gives you perspective. Hey, the US wasn't always, the big game in town. The UK used to wear the crown. By the way, the UK stock market is like a third the valuation of the US is today. And then before that, Amsterdam, on and all. And then you see these cycles of credit creation, and whether it's through sovereigns, the government, whether through it's private, whether it's through different areas, and other times of deleveraging, inflation, deflation, all these different macro forces at play. And what you find that over time, you want exposure to risky assets. You want exposure to stocks. However, as you said in the beginning, that volatility, that geopolitical headline risk, the drawdowns are the price of admission. And I think that's a feature, not a bug, but it's hard, right? Like if anyone who lived through the GFC, lived through the dot-com bust, knows that it's hard to sit through those 50% downdrafts. And so looking at markets when they're expensive, like they are in the US, historically speaking, when you traded a 10-year P/E ratio of 40, which is where we're at, when we look at all the global markets historically back in time, foreign markets as well, you find that on average, the returns are low single digits over the next decade.
Yeah.
And on top of that, never once have we found in history when a market closes above 40, are the future 10-year returns above average. So knock those expectations down a little bit. Maybe we'll be the exception ever. Um, but those are through different time periods, different things going on, and things can always be different. Maybe the robots take over, and we're all servants to the metal machines here in 10 years. Who knows? But it certainly feels like a time when and to be clear, the prescription on this is there's not only one choice when it comes to equities.
Yeah.
There's a whole secret menu available of you don't have to do market cap weight. You could do equal weight. You could do shareholder yield. You could do value. All sorts of different strategies that I think will do much better in this period.
Got it. And I definitely want to kind of walk through some of those. But the one thing I found interesting, I know that you've talked about valuations in foreign markets being better than just sort of this US dominated Mag 7 big tech world. And for a long time, people weren't paying attention. But this year, obviously, we've seen foreign market outperformance. We've seen, some inflows into parts of the market that previously weren't of much interest. I'm curious about your thoughts on the durability of that. Do you think the outperformance we've seen in foreign markets in 25 might be something, a turn of that wheel, so to speak?
Um, Lost in you turn on CNBC, turn on Bloomberg, not here at the Money Show, but all they talk about is, Nvidia, market's expensive, concentrated, US stock market at an all-time high. Again, and it's every story, but lost underneath the surface, the turbulence of the waves, very quietly, as you mentioned, some other things are starting to really outperform. And it's been so long, I think people have even forgotten there's other assets other than S&P 500. We did a paper a couple years ago called The Bear Market and Diversification. And we argued that if you have a diversified portfolio, and it doesn't even matter which one, it could be 60/40, endowment, risk parity, whatever, all those underperformed since the GFC by arguably the worst in history. The only period that's comparable is post World War II in
Yeah.
terms of years in a row and magnitude of underperformance. So the S&P killed everything. So a lot of people have said, why do I own anything other than the S&P? and that could be bonds, real estate, commodities, on and on. But this year, over the last couple of years, actually, very quietly, and I think it started with 2022, you're starting to see things outperform. So gold, for example, that one's actually kind of in the headlines now because it's put up back-to-back really impressive years. I can't say Bitcoin anymore, but foreign stocks, up 25, 30% this year. And very quietly, a lot of people talk about how values underperform. Deep value outside the US, so we have a strategy that does this, is up 50% this year. Very quietly. No one's clamoring for this. There's no sentiment where everyone's saying, "Oh my God, we got to buy stocks in these deep value countries." And that's actually now outperforming the S&P over the last 1, 3, and 5 years. So a really interesting time that I think you start this rotation. People, it may not just last a year; it may last the better part of 3, 5, 10 years.
Got it. And just a reminder, Mark mentioned it at the outset, but I'm going to just add this is meant to be interactive. So if you have any questions, just type them into the chat, and that way we can get to address them during the half hour we have here. Meb, you have some great commentary on your website, some of the things that people can look for free, and I find it interesting from a big picture lesson perspective. One of which was your most recent paper that quite simply and clearly was named "When to Sell." Can you talk a little bit about what your points were there? Some ground that pointers, I guess, when somebody's trying to decide, hey, should I keep hanging on to this investment that's not working out for me?
This is a tough one because a lot of the professionals, we spend a lot of time talking institutions manage a billion, 10 billion, 100 billion, 500 billion and more. And I love to pick on my local state CalPERS institution because even the big boys with unlimited resources, hey, your budget's unlimited. You have access to the top hedge fund managers in the world. Um, Often don't do a better job. We've written a lot of articles over the last 10 years. Should CalPERS be managed by a robot? Should Harvard fire everyone and buy a bunch of ETFs? And the conclusion is usually yes. And part of the struggle is that, low cost global investing is hard to beat already, which is a good thing. So even somebody who's got $10,000 in their Robinhood account can get access to investment strategies that are on par with CalPERS and Harvard. That's amazing. But second of all, part of that is just because those in charge there have the same human frailties as individuals do, such as they love to chase performance.
Yeah.
And this is like almost just the most ingrained thing in your human condition, where if you look at individuals, often I think on the buy decision, they do a fair amount of research, not always. But hey, I studied this fund manager. I studied one of Meb's strategies. I even read the prospectus. I read some of his books. I listened to his podcast. I think this is a great fund. I'm going to buy it. And then, sure enough, it could be 3, 6 months later, and we have 20 funds, so something's always stinky, right? So something's always underperforming.
Yeah.
And with 150,000 investors, somebody's always grumpy, and somebody will invariably come up to me, at a money show or somewhere else and say, "Hey, Meb, I bought your fund, 6 months ago. 6 months ago, it's doing terrible. What do you think? What's the problem here?" And my usual response is, "Oh, it can get way worse than that. That's it. Like that's nothing. Like it could go down for years in a row if we know anything." And so, study after study, Vanguard's done this, others have done this. I mean, even looking at Buffett, you could have the world's best strategy, and over the course of a decade, it could underperform 2, 3, 4 years, and not only
Yeah.
4 years, 4 years in a row, right? So the argument of this article was, hey, how to think about selling ahead of time. Because if you ask investors, hey, when you bought this fund, security, stock, did you put in what the sell criteria is going to be when you bought it? And no one is ever yes, right? They're just like, I'm going to buy it, see how it goes. And what does that mean? That means over the next 3 years, if it outperforms, you'll keep it. You'll think that person's brilliant and think you're brilliant for buying it. You'll tell your neighbors how smart you were for buying this fund or idea or strategy. And if it does poorly, you'll sell it. I was so stupid. I can't believe I listened to my golfing buddy recommend that, on and on. And if we know anything, all the research shows horrible, terrible, very good, no, very bad idea. We had Ken French on the podcast, a famous academic, and we said, "Ken, how long do we need to know, performance statistically speaking, if a manager's good?" And he said, without skipping a beat, 64 years. And I said, okay, that's a little longer than most people. Most people are probably 64 days, 64 hours. But the point I think he was trying to make is anything under 10 years is noise. And so we tried to walk through hey, how do you think about this investment? And are the reasons you're selling good reasons, or are you kind of chasing your tail, so to speak?
Got it. And you do have this book you mentioned that's coming out next year, Time Billionaires. History of the stock market is going to talk about some of the things that the wealthiest long-term investors stick with. How does that factor into this discussion? What, without giving away the story, I guess, what kinds of things are you going to add, cover in that book?
There's nothing to give away because it's a story as old as time. And that story is, if you save money, and this is the big part. So this is geared towards, particularly younger people, meaning that people that have time billionaires, right? My son, he's 8, and say, look, you invest in the global stock market. It's important to me that it's global, not just one country. And, let's use 10% just because that's easy math. And you put money to work, let's say you can scrabble together $10,000. In 25 years, that 10x's, right? So that 10,000 is now 100 grand. You didn't do anything. You just put that money to work and let it compound. In 50 years, it's a 100 bagger, right? So, you're graduating college by the time you retire. If you can just save somehow, scrape together 10 grand, that's $1 million. You don't even have to do anything. You've won the lottery, right? But it walks through all the like pitfalls too. Investing in just one country is a huge what we call home country bias. And in the US, everyone I know, everyone listening to this, you probably put 80, 90, 100% of your stock allocation in US stocks. And we argue why that's a bad idea. Because you go through time, go through history, and look at all the other countries and 45-ish investable countries and say, was that a good idea? And you'd say, no, terrible idea. Even in the US at various points, 15 years ago, people would probably say, no, my God, terrible idea. Everything has creamed US stocks over the last 10 years. So we walk through this global approach. We walk through just how bad, I love to pick on the youngins, the young folk who are always saying, it's so tough right now. It's so hard. These markets are so tough. And I was like, are you kidding me? And so we walked through a few times in history and demonstrate how difficult it was. I mean, you got to remember the US stock market declined by 80% plus during the Great Depression. Imagine sitting through that. That was rough. So it just walks through as the most magical thing, this compounding these markets, but it's not easy, and try to avoid some of the mistakes so you can capture some of that elusive alpha out there.
Got it. I do have a couple questions that have popped up, and I want to get to them in just a minute, but I do want to try and make it a little bit actionable, talk about maybe styles, strategies, parts of the market that look interesting to you here. Anything that's kind of an open-ended type question. I figure if you can share that.
So we mentioned the US stock market's expensive. Now, the solution to that I think is pretty easy. You break the market cap link. Um, and what could that be? That could be equal weight. It could be shareholder yield, which we think value within the US is Grand Canyon wide spread versus the market cap weight. And market cap weight historically is a great entree into the markets, but it's suboptimal. And so you look at things like small and mid caps, which have underperformed forever versus the market cap weight. So huge opportunity there that I think could last many years and many dozens of percentage points outperformance. Second would be most US investors have very little to no allocation to foreign and emerging market stocks. As you mentioned in the beginning, they're outperforming the S&P by a ton this year, but historically it's a coin flip any given year. So you could have a period, same thing where the valuation spread is Grand Canyon wide, some of the highest it's ever been in history for these foreign and emerging markets versus the US. So you could have 10 years of foreign stock outperformance. That's a big one. You're looking at these valuations where we mentioned the 10-year on the US PE being close to 40. Well, in foreign markets, it's in the teens, so it's half that. And the cheapest bucket is down around 12, so a third or a quarter almost of the US. Those are huge opportunities. A lot of people, we probably don't have time to get into this, but a lot of people say, look, man, I believe everything you've said, but I'm taxable and I'm sitting a tax count and I can't sell these Mag 7. I can't sell SPY. Taxman's going to kill me. We do have an interesting solution we've been talking about quite a bit called 351 ETF exchanges that allow you to seed a new ETF launch and it be a tax deferred contribution. Those are all pretty exciting choices. And then we could save a couple minutes to talk about the warning and fixed income, which is something that I think no one's talking about that I think might be interesting to this audience.
Sure. Take a minute or two to talk about that, and then I'll tee up a
Yeah.
couple of these questions.
So we wrote a paper a couple years ago called T-bills and chill most of the time. And what was that about? There's kind of this curiosity. and it was based on a blog post I wrote, I don't know, 10, 15 years ago about the yield curve, meaning, if T-bills, and I'm just using broad numbers here, if they yield 4%, historically, something like the 10-year or the 30-year are going to yield 5 or more, right? It's this
Yeah.
upward sloping curve. And then you had this weird period for a long time where the yield curve was negative. So it was inverted. You had the longer yielding bonds yielding less than T-bills. And if you look at the whole curve of risky bonds, so things like corporate bonds and junk, there's some of the slimmest spreads in history, or at least going back 30 years. And so we kind of scratched our heads, and kind of like in stocks where you say, well, look, you buy a stock, Warren Buffett, Ben Graham, you want a margin of safety. Doesn't make sense to buy stocks usually that are 200 times revenue. So same thing with bonds. I was like, did it make sense historically? And we modeled this out last 100 years to buy these risky bonds when they weren't giving you much pickup in the way of yield? And the answer was, surprisingly, it was a terrible idea. You shouldn't be buying these risky things when they're not giving you the pickup in yield. So we actually launched a fund called TYLD, but we modeled it out. And so here's an example. You look at 10 sleeves of the bond market and say, are they giving you above average spread relative to T-bills? 10-year, 30-year, mortgage back, corporate, junk, even REITs we include in there, tips, ag, all that stuff. Okay. That strategy today would be 100% in T-bills. Because the thing that people get wrong about fixed income, I think, and this is the one that no one agrees with me on. Okay. So this is not well known, well discussed. Um, Everyone looks at fixed income and they see the absolute number. Is this number high relative to its history on an absolute level? But to me, that's not the right question. The right question is this number high relative to the risk-free rate, which is T-bills? Because you can just hang
Yeah.
out in T-bills and get that income. And so, it's a curiosity that things, particularly on the corporate and junk side, if we know anything about markets, we know that when the VIX goes to 50 and volatility explodes and some geopolitical crazy event happens, corporate bonds go from yielding 5 to yielding 9 or something, and junk goes to 15.
Yeah.
Then it makes sense. So that's a curiosity, and I don't know that I don't know that anyone cares, but to me, it seems like you're not getting paid to take on the risk in fixed income land.
Yep. Yep, fair enough. A couple of these questions, we'll see if it's something you want to get into, but I did find this one interesting just given that it's been such a popular part of the exchange traded world. And that was, what are your thoughts on the covered call ETNs, ETFs?
Um, you know, when it comes to markets, it's like Baskin Robbins, to each their own in my mind. I'm a mint chocolate chip guy. If you want that rocky road, good for you. Um, there's a lot of things in the investing world that I think are unnecessary, but if it helps you get to the finish line, God bless. And so, I think my default in general when it comes to investments is simple, low cost, tax efficient, which means ETFs in general and strategies that I can explain to my neighbor. I think some of these, can encroach upon the territory of can't explain to your neighbor or can't explain why they might be good or what they're actually doing that is thoughtful. I do think that everyone loves this concept of passive income. This
Yeah.
applies to dividends, it applies to yield. Everyone has that fantasy of sitting on the beach in Cabo and sipping pina coladas while those sweet checks roll in. And it sort of depends where you are in life too, because if you're compounding, you actually don't want the income or dividends, right? And a lot of people, this is kind of sacrilege. We actually launched a fund last fall, tax is the ticker, that's targeting US stocks that pay low to no income. And everyone's like, who would want that? That's crazy. Well, if you're reinvesting, which you have to reinvest the dividends and income to get that 10% stock yield, last thing you want on the planet is income coming in, you pay taxes on, and then going back to reinvest it. So, but if you're a retiree, you want to spend it, you're comfortable with it, you think it's a good strategy, good for you. I'm happy for you. It's not something that I'm particularly attracted to, but to each their own.
Yeah. There's a couple questions that came in sort of crypto or crypto adjacent. One says, interested about Meb's thoughts on AI and crypto. Are they here to stay or are either of them in a bubble?
Um, well, we trained a custom GPT on all my writings. So you guys could actually go ask if you Google Meb AI and it's on Chat GPT. It's public. You can go talk to me and ask it questions. Be like, hey Meb, here's my portfolio. Not investing advice. This is for entertainment only.
Mhm.
Don't ask it relationship advice. It'll start talking to you about volatility and drawdowns. This is really, but it's probably 80 or 90% what I would say on all these sort of ideas. It's actually really quite good. We asked the other day, we said, Meb AI, what's the best investing opportunity for the rest of the year? And it was like, well, I would never say something that's short term or would never say just one idea. I think in terms of diversification and allocation, but foreign stocks certainly look cheap relative to the US. And it went on this whole spiel that sounds exactly what I said earlier. Um, so I think AI is obviously going to be transformative. We think it's a lot of fun and interesting. Um, where is it going to accrue? I think everyone assumes that AI is going to accrue A to the US and B to the big companies. And I don't think that's necessarily the case. Like you could have a situation where the benefits of AI, we had Joe Davis, economist from Vanguard on the podcast recently, and he said he thought AI, the benefits will start accruing to, a lot of the smaller, mid cap type of stocks in the US, the value stocks, because it's their profit margins, they'll start to become more efficient with a lot of their operations, which I thought was an interesting take.
Yeah.
And it's also, I think, questionable to assume that it's only going to be in the US. We saw this with DeepSeek last year, where everyone started freaking out because China had, this great AI model. And I think it'd be foolish to assume that this is going to be a US only phenomenon and then, China, India, Singapore, who knows, Brazil, could easily develop a lot of technologies and ideas that are interesting. Do I think that the stocks are crazy expensive? I do. I do a lot of angel investing and the amount of companies, it's like 80% of the companies I see are AI companies, no revenue. If they do have revenue, the valuations are going off on 50 times revenue, et cetera. So I think there's, it reminds me a lot like the 90s where there's a lot of spending, a lot of overbuilt, benefits humanity. But, if you look at the remaining players from the late 90s tech companies out of the top 10, I don't think any of them outperformed the market over the next 15 years, and it took Microsoft 18 years to be
Yeah.
an outperformer. So, buyer beware in the public markets. I think a lot of the big ones are getting pretty pricey.
Yeah. And the related question that just came into was, do you think, if you want to weigh in on this, do you think we are in a crypto winter now?
It went from summer to winter pretty quick, huh? Crypto to me, the way I think about it is the least satisfying answer to anyone, which is invest in crypto as a percentage of the global market portfolio of public assets. And so if you buy the entire portfolio of all the public assets in the world, it's roughly half stocks and half bonds, half US and half foreign. And you got to remember, US is only a quarter of world GDP. So no one does that, right? There's no one out there that puts half in foreign listening to this unless you live ex-US.
Yeah.
But where does crypto fit in that? Crypto is like 0.5%, maybe 1% of the world portfolio. So if you want to put in 0.5% in Bitcoin or a percent, all my crypto friends hate hearing that because they think you should put in half or all. And all the rat poison crypto haters hate it because they think it should be zero. But to me, it's the big takeaway from being an allocator is you want to be asset class agnostic. And that applies to everything. It applies to stocks, bonds, REITs, gold, for example. Gold's a great, interesting one this year that almost no one owns. So these type of things, look, we have a sliver in Bitcoin, but not much.
Got it. Okay. We got about a minute or two left. That's covered all the questions I had queued up. Anything parting words, I guess you'd advise people, whether on the fixed income front, on the stock market front, or just
Sure. Take the long view. One, second, if you guys find yourself in Manhattan Beach, come by. You see my new hat. We have a new fund launching next month. If you're interested in the 351 stuff, reach out. More than happy to give you a hat or a book. We have a research service called the Idea Farm that's free. It goes out to well over 100,000 people. That's kind of the top reads of the week every Sunday. And take a listen to the podcast and stay tuned for the new book and content. And if you get bored and want to talk to me, hit up my AI and tell me what you think. And if it says anything particularly funny, reach out to me and let me know. I'd be curious to hear your feedback.
Perfect. Well, Meb, again, I appreciate your time. A lot of good information there. Long-term focus type advice. Sometimes you don't hear it, and it's what people need to hear on a day and week like this. Meb, thanks again for your time.